All right, all right, all right. Bang, bang, bang. What's going on, guys? Let's wait a few seconds here as people come in, and then I will start answering some questions. First off, I want to really cover, there's a lot of misconceptions and things that people don't understand about the financial crisis and kind of how this plays out, how it's played out over time. In previous financial crisis. So I'm going to do my best to answer some of those questions. The most important thing is people need to understand that there's cycles or kind of stages of a financial crisis. And the most important thing that we've seen over the last couple of weeks is something called a liquidity crisis. And during a liquidity crisis, basically fear and uncertainty rules the day. And when there's fear and uncertainty, every single person wants the security of liquidity. Right. And what liquidity basically means is they want US dollars. They want to have the ability to take those US dollars, make sure they can weather the storm, and then also buy assets if they need to buy those at any point as well. And so during a liquidity crisis, essentially what happens is anything that you own, right, as a financial asset, investment asset, et cetera, anything that has a liquid market to it, whether it's stocks, bonds, other currencies, gold, Bitcoin, anything, you sell it. And you sell it as fast as you can. You're less sensitive to the price at which you sell it because you simply want dollars, and then you hold those dollars. And so we've seen that over the last couple of weeks. And I think a lot of people have mistaken the liquidity crisis for the actual financial crisis. But the liquidity crisis is simply the start of the financial crisis. We then will enter into the actual crisis itself, where we see the domino effect or chain reaction. You'll see everything from suppliers going out of business because there's other businesses they can no longer sell to. You'll start to see all of the real estate issues. You'll start to see public and private credit issues. You'll see the pensions that really come under pressure. That's where the true financial crisis happens. The simple liquidity crisis isn't as bad because it's just people looking for liquidity. So they sell everything they can, asset prices go down, they get the liquidity. Think of it as the dollar strengthening and those asset prices selling off. So that's kind of a big piece of this. If you guys want, ask your questions in the comments here. I'm going to do my best to get through a bunch of them. I'll hang out for about 45 minutes or so. So fire off those questions and I'll get to them as I get through this monologue here a little bit. But the other piece that I think people are missing is there is a huge disconnect between what's happening in the public markets and what the reality on the ground is, right? So there's been this rally in the stock market. And I think a lot of people are saying, wait, why are stocks going up? But instead, the reality on the ground is that 16 million Americans have filed for unemployment in the last 3 weeks. Still, 50, 60, 70% of small businesses in America are shut down through a government mandate. And you and I are all sitting at home and not allowed to go out. And so I think that what we're seeing is a dislocation of the reality and what's happening in the public markets. And so we just have to remember that stocks can go down. They'll recover in these kind of relief rallies. They can go down even more. There can be another relief rally. They can go down even more. And also they can go sideways for a long period of time. So don't get caught up in, stocks are recovering. That must mean this financial crisis is going to recover tomorrow, right? There's still a lot of shelter in place orders, Virginia and DC, et cetera, that are till June 10th. Right? Literally, there are states and territories that are saying people are not going to be able to leave their home till June 10th. And so that's another 60 days away or so. So I just think that there's that dislocation or separation between reality and what's happening in the public markets. And so people need to be educated. They need to understand how this sequentially plays out. There's a liquidity crisis up front. Everyone wants dollars. Asset prices sell off. The dollar gets stronger. Then you're going to see the intervention from the government. And what the intervention really is the government stepping in and saying, we need to weaken the dollar. And the way that they weaken the dollar is they're going to flood the market with liquidity, right? They're going to put as many dollars in as they can. Around the world, other central banks will also flood the financial system or the global financial system with liquidity. And what that really does is that stabilizes kind of the free fall of assets. And then ultimately over a long period of time or a medium period of time will reverse and asset prices will start to recover. And so the reason why this is important to understand is as the dollar is getting stronger in the short term and asset prices are selling off, what will happen is or that's called a deflationary environment, right? The dollar is literally getting stronger. It takes less dollars to buy more of the same assets, but that will reverse, and we will then head back into an inflationary environment where you'll get a reverse effect, where basically now the dollar is going to weaken and asset prices will rally. And so what really happens is when that reversal happens, the bottom 50% of Americans get hurt. And that's what I want to spend some time talking about tonight, is how you can protect yourself from that inflation. Because I think the big problem right now is it's just an education problem, right? People don't understand how this occurs. They don't have like a very good understanding of the sequence of events that will occur. And then they don't know what to do. And I'm not here to give necessarily financial advice in terms of, hey, buy this stock or do this, but more so just give you a framework of how I think about it, how a number of other investors think about it, and what you at home can do to protect your wealth during these inflationary times. So let me see if I can jump on some of these questions, and then we'll get into the details as we go. Hey, Pomp, thanks for all you do, sharing your knowledge. Yeah, of course. I enjoy making all the videos, so happy to how to do it. What's my view on XRP? I've pretty much covered all of the crypto stuff. So I'm not going to get into too much crypto stuff. Can I explain why stocks are going up as unemployment is skyrocketing? Yeah. So this is what I'm talking about. There's this dislocation between what's happening in the public markets, right? Investors are speculating. That's what happens in the stock market. Investors are speculating on what's going to happen in the future. And when they see the announcement of all of the stimulus, they get excited. The rich people, the people with assets in the stock market, they cheer, right? And they get excited because they know if they own stocks, when liquidity floods the market, the dollar will weaken and stocks will rally over a long period of time. So you see them buying into the stock market, seeing that quantitative easing is coming, right? Or the printing of more money, the injection of liquidity. The second thing is there's a lot of speculation around when will there be a cure or a vaccine for the virus, right? There's a number of investors or a percentage of the investor population that believes once there is the ability to come out of quarantine, we will essentially have what they call a V-shaped recovery, right? There was this big drop in economic output, unemployment skyrocketed, but the second that we're allowed out, businesses will come back online, economic output will restart, the velocity of money will restart, and those people will go back to their jobs. I personally don't believe that's going to happen like that. I just do not see the American economy going from operating at an all-time high kind of, absolute bull of all bull markets to then going into this massive decrease in economic output, a complete stop of velocity of money, and a skyrocketing of unemployment to then just go right back to the bull market, right? I just don't see that happening. And it's because if anyone's ever run a business before, you can't simply be operating today, shut down tomorrow, fire 80% of your staff, and tell your customers, hey, we're shut down right now. And then the next day, start your business back up, hire back 100% of your employees, and all of your customers come back. It just doesn't work that way. And so I think that we're in for a long road to recovery, and a lot of the speculation that's going on in the stock market, it would not surprise me to see massive sell-offs when earnings are announced over the next couple of weeks, right? And really it's because, again, if you go back and you look at something like a United Airlines, right? United Airlines, I think last year did about $6.5 billion in EBITDA. At some point earlier this year, it was trading below $6 billion in market cap. So 2019 EBITDA, $6.5 billion, 2020 current market cap was below $6 billion. You would say, wow, it sold off from an $80, $85 stock down to $20, $25. That's a steal. But in reality, if you look, well, what is United's revenue going to be this quarter? Right? It's not going to be equivalent to a $6.5 million or $6.5 billion annualized EBITDA. It's going to be something much lower. And so, in fact, even though the stock fell, $60, it still may be overvalued given where the company is today. It still has assets, it still has employees, it still has a business, but the revenue numbers are going to be drastically down. And so, if you go and you look at something like the movie theater industry, right? I think it's the third week in March in 2019, the movie industry in the US, the domestic box office, did about $200 million in revenue. This year, 12 months later, it did $5,000. So one way to look at that is literally if the stocks of the physical movie theater businesses fell 90%, they still would be overvalued if you compare it to the revenue, which fell 99%. Right. So you can't simply just say, oh, the stock prices fell a bunch. Of course, that's a better value or a value buy type stock. The second thing is how many people are going to run right back into movie theaters and be cool with sitting a bunch of many strangers and breathing the same air, being in a place where they're not sure, did it get cleaned, did it not get cleaned? There's a virus that still or may not be on the loose, et cetera. So I just don't think that it's going to be this V-shaped recovery. And so while the stocks are rallying and unemployment skyrocketing, I think that really just signals that there's this massive dislocation, and it wouldn't surprise me to see another massive sell-off as people realize, hey, the reality on the ground doesn't reflect the way that we're currently allocating capital. And that's the beauty of markets, is markets are the ultimate referee, right? They will eventually find equilibrium if people don't manipulate them, if the government stays out, et cetera. So I think that'll be really good to kind of watch. Would you buy silver or gold stocks? Again, I'm not going to sit here and kind of pick stocks or do anything like that. First of all, I don't enjoy doing that. Second, I don't think I have any advantage over anybody else. But more so, I want to kind of share the framework as to how I think about this. And so talking about silver and gold, and I'd also put Bitcoin and real estate in this category, is these assets act as inflation hedges. And what I mean by that is right now in a deflationary environment, dollar getting stronger, asset prices selling off, the government's going to have to flood the market with liquidity, right? Or the central banks will. They're doing it all around the world. In the US, we now have trillions of dollars already announced. There will be more. And so what I think ends up occurring is that we will switch back into the inflationary environment. When that occurs, investors will seek inflation hedge assets. Silver, gold, real estate, Bitcoin, et cetera, will all be assets that they look for, because again, the currency is going to go down in value compared to the asset. So in January of 2020, let's say it took $100 to buy a bar of gold or a piece of real estate. Now, in a deflationary environment, actually what happens is I can only spend $80. I can buy that same bar of gold or that same piece of real estate. So it takes less dollars to buy the same real asset. But when we go back into an inflationary environment, it'll go from $80 back to $100, eventually to $110, $120, $130. So over a long period of time, it will actually take more dollars to buy the same asset than it previously did. And the reason why investors will run out of the dollar and into these assets is because those assets are going to appreciate in price in US dollar terms. And so things like silver, gold, Bitcoin, and real estate will all benefit from that. Let's take a shot each time Pomp says liquidity. I'm not touching any of the drinking games. You guys, you guys are the experts on that. You want what other people want. If other people want dollars, then you want dollars. This is a really good point. So Jeff brings up a point about most investors are going to want what other people want, right? That is true to a degree. But over a long period of time, actually what you're going to want is you actually want what other people are about to want. Right. So it's a nuance, but it's an important nuance, meaning that if everyone wants dollars right now and you've got a lot of dollars, right before they're going to want the real estate or the Bitcoin or the gold or the stocks or the treasuries or whatever the next asset they're going to want is, you actually would want to then go into those assets right before everybody else, right? You want to buy it when it's unpopular, right before it becomes popular. Now, part of the risk of investing is you got to pick the right asset, you got to pick the right time, et cetera. And so timing the switch from the deflationary environment to the inflationary environment provides opportunity, but it also provides risk. And so people need to understand the risk that they're taking, but that is part of the opportunity here. And so what I think you're going to see is Apple, right? All-time high in levels of cash. Warren Buffett, all-time levels in cash, right? I think $120, $130 billion in cash. What they've done is they basically hoarded cash before everyone wanted it. So they foresaw that there was going to be a deflationary environment. They held their cash. Now everyone wants cash. They have the cash. He who has cash during a liquidity crisis makes the rules. And that's what we're seeing right now. So all of a sudden, when we go right before we switch from that deflationary environment to an inflationary environment, you're going to see Apple, Warren Buffett, other people who have big hoards of cash. They're going to deploy that cash. They're going to buy up assets at the low values that they've crashed to. And then all of the inflationary aspects will hit, those asset prices will rise, and those that are then holding the assets will actually benefit. And so it's not kind of a black and white, take one strategy and do this forever. You also have to understand the cycles or the sequence of events during a crisis. And you've always got to be one step ahead of the masses, because that's how you buy the asset that everyone's about to want, right? I've got a partner, Mark Yusko, who always says humans are really good at doing two things. They basically buy the asset that they should have bought, and they sell the asset that they're about to need, which means that they basically follow the herd, right? Once they see that stocks have rallied 300%, then they buy into stocks. But they should have bought it before it rallied 300%. Duh, if they had a crystal ball, they would have done that, right? But then what happens is when the stock market crashes, then everyone sells. right? And they sell what they're about to need. And so when the stock market crashes like it did in a deflationary environment, what happens is there's the liquidity injection and stocks rally. So they literally just sold the asset that they're going to wish in the future they would have bought. So kind of staying one step ahead is really important in those environments. I've been watching 80% of your interviews and I'm still poor. I appreciate the laugh there. Let's see. Pomp, how do you feel about Tether with how much printing they've been doing lately? Do you think it could end up hurting Bitcoin somehow? So on the Bitcoin front, basically what I'm going to say here is I'm not worried at all about Tether. I know that there's a lot of people who are. I'm just not one of those people. And then on the more macro environment, the way that I think about Bitcoin's prospects moving forward essentially is we've had interest rates drop to zero. We've got tons of quantitative easing happening or printing of money, both in the United States and globally. And right as the effects of that stuff starts to take place, that switch from the deflationary environment to an inflationary environment, we're going to have a supply shock, right? And the reason why the supply shock is important is right when everyone turns to the inflation hedge assets, Bitcoin's incoming daily supply is going to drop 50% from 1,800 Bitcoin a day to 900 Bitcoin a day. And so right when that supply shock happens, you also will have a demand shock, right? Supply will go down or incoming daily supply will go down. The demand for Bitcoin, gold, real estate, et cetera, inflation hedge assets will go up. And so you get this kind of double move where supply goes in the favor of a higher Bitcoin price and demand goes in the favor of a higher Bitcoin price. And all of that happens simultaneously. And therefore, I think it will lead to a very large increase in the Bitcoin US dollar value over the next 18 months or so. So again, there's risk in that. And it's important that people kind of do their own research. They understand how to size the risk appropriately in their portfolio. I for sure am not telling people, hey, go take 100% of your assets and go buy inflation hedge assets. Part of protecting your wealth during a financial crisis like this is making sure you have enough liquidity to weather the storm. So I continue to ask people, do you have 3 months of cash, 6 months, 12 months, 18 months? How long can you last as an individual, a family, or a business with no income or no revenue, right? Kind of zero revenue run rate. And the sad part is a lot of people can't last that long, right? And that's where you get things like the payroll protection program, unemployment, right? All of these programs that have been put in place to try to help people. But ultimately, the people that are going to benefit the most going through this period are the people who already did the hard work. Right? They already did the disciplined, unpopular, hard thing. They didn't get overextended. They didn't get over leveraged. They conserved cash, right? They did all of these things. And now they're in a position to thrive coming out of a financial crisis. Most people are not in that position. Most people are actually going to be in the position where they're going to have to do their best to try to conserve cash now. They're going to sell assets. They're going to do whatever they can to get that liquidity so that they have the liquidity to actually weather the storm. So step one is never run out of money, right? Whether you're a business or an individual or a family. And so people have to understand this isn't going to be a 2, 3, 4 week thing, right? This is going to be a long-term financial crisis, not just the actual crisis itself, but the recovery. And so what I continue to tell people is make sure you have cash to weather the storm 3, 6, 9, 12, 18 months, however much you can get, make sure you have it. And then understand as we start to recover, you're going to want to own some of those real assets and benefit from that price appreciation over time. Do I think we'll have a second dump in the S&P 500? Again, I don't know or think I have an advantage in timing the market. I don't think that I've got some special skill of picking stocks, but I do believe that there's a dislocation between what public market investors are doing and the reality on the ground. There's a whole bunch of reasons why. But I also think that the moment that is upcoming where we're going to see some earnings reports, I think it's going to scare people, right? I mean, who's ready to see a movie theater business or a corporate, a commercial real estate ETF, right? These people report 99% loss in revenue. I just don't think people are pricing that type of stuff into the market. And so we're going to see what those earnings reports look like, but I think that they will be worse than people expect, which I think is going to cause some panic in the market. And we'll see kind of what happens there. Do I use technical analysis? No, I use no technical analysis. I don't do any trading. I am much more of kind of an asset allocation type investor. So I basically look structurally at markets. I look over long time horizons. So anything that I buy, I hold over a medium to a long term. There's no day trading going on. There's no technical analysis, price targets, anything like that inform my investment decisions. And right now, I see a couple people asking kind of how I'm currently allocated. I've got Bitcoin is a big percentage of my portfolio. I've got some real estate. I've got some illiquid investments in the startup and venture capital space. And then I've got cash. Right. And that's kind of how I'm currently allocated. I don't invest in public markets for a whole bunch of reasons. And so also don't own any gold, oil, anything like that. And so it's pretty much Bitcoin, cash, real estate, and then some private investments in the startup or venture capital space. Where to buy bonds and gains from asset bankruptcy. I'm not an expert when it comes to buying the bonds. There's people like Raul Paul, Real Vision, et cetera, that are much more well-versed in that and can kind of give you exact execution tips there. What I will say is I don't think that we've seen the actual bankruptcies yet. So again, going back to the sequence of a financial crisis, you get the liquidity crisis first, then you get these relief rallies, then you get the quantitative easing and the switch to the inflationary environment, and then you get the recovery. During that first half is where you get the pain, but you actually don't see a lot of the bankruptcies immediately. Remember, this financial crisis is 4 to 5 weeks maximum in the life cycle, right? So we're only 4 to 5 weeks in. This would be like the first 4 to 5 weeks in 2008. We knew that we were headed for trouble, but we didn't actually see the really gnarly, like kind of blood in the street stuff for a couple of months. And so I think that people just have to be patient and understand that there are going to be a sequence of events that play out. Don't evaluate the severity of a financial crisis simply in the first 3, 4, 5 weeks. I think you've really got to understand the reality on the ground. The reality is 16 million Americans have applied for unemployment in the last 3 weeks. Those are the people who successfully did it. That doesn't include gig economy workers, freelancers, self-employed. It also doesn't include some people on furlough. It doesn't include people who can't get through, right? The log jam, et cetera. And so right now, at a minimum, there's 21 million Americans unemployed. My guess is that it's actually much higher than that. And then we've got 70 to 80% of small businesses in America that are shut down through a government mandate. I just don't see us recovering anytime soon. So kind of be patient, I think, is a big part of this. How deep do I think the second leg in the downturn is going to be for S&P and Bitcoin? So I saw a really interesting analysis. Tavi Costa, I don't know how many of you guys know him, but you should go follow him on Twitter if you don't. He does a lot of macro and then gold and some commodity analysis. And he posted a chart where he basically showed during the Great Depression, there was a very steep decline on the public market. There was a 25, 30% relief rally, I believe it was. And then there was, again, another like 25, 30% down. Don't hold me or quote me on the exact numbers, but basically what it looked like was there was this drop, there was a recovery, and there was a second drop. And when he lined it up, it looks very similar to now. Now, again, history doesn't have to necessarily repeat itself, but it definitely rhymes. And I think that we are likely to see that, right? This is all a game of probability. There's no absolutes here. So anyone who tells you for sure we're going to see another low, they're lying or they're confused or they're tricking themselves, right? But also anyone who says, well, we definitely won't see another low, again, they're lying, they're confused, or they're tricking themselves. And so I think it's a game of probability. And if you said to me, you have to choose a side, I think it is more probable that we will see lows in the public markets and other assets. It is more probable we'll see that than we will see the full recovery. And so I think people just need to kind of understand the game of probability, understand the risk reward there, but don't be surprised if we do see that fall in public equities, both from the earnings reports that will come out, but also just kind of the nature of the market or the market structure. Let's see here. When do you expect the inflation for USD to start? Again, really, really hard to kind of nail down exact timing. I'm not a trader, so I don't look at like, hey, on this day, we're going to see the dollar weaken, and therefore I'm going to short things. Polina's cooking dinner, and I think that she just broke everything. That's fine. But in terms of the US dollar, I think that we will see inflation. Obviously, we'll move from the deflationary environment into an inflationary environment. I expect that to happen over the next kind of 12 months. Really, it's going to come down to how much money do they print. Right. The first $2 trillion stimulus package, I don't think is nearly enough. I've said kind of from the beginning, at least $5 trillion, I think is what they're going to have to use to flood the market. That's just the US. Remember, all around the world, seeing liquidity in the market. Japan's almost $1 trillion plan. Many other central banks are announcing big stimulus packages. And so we're going to see trillions of dollars that's kind of injected into the global financial system. And all of that capital is going to be needed in order to move from a deflationary environment into an inflationary environment. Again, exact timing, I'm not going to sit here and make any predictions, but I do think it'll happen over the next 12 months. And if you kind of position yourself correctly, both with, hey, I've got enough cash to weather the storm, and I understand when we move into that inflationary environment that real assets or inflation hedge assets are going to do well, then I think you'll be set up really well over a long period of time. So we'll see there. The public market dissonance is real. Is there any credence to the V-shaped recovery theory? Again, I mentioned this a little bit. I don't think necessarily that there's going to be a V-shaped recovery. The way I tend to think about this is I see a lot of people basically say that it's a V or it's a U, right? I tend to think that it's something in between a U and an L. Right. And the reason why I say that is you basically get this big drop and then you kind of get this grinding up of the recovery. And it's because, again, this stuff takes time. Right. If you think of the velocity of money, right, or what I call like the economic circle of life, we basically took that economic circle of life where suppliers go to manufacturers create products, they give them to businesses sell that to consumers, businesses then pay rent to landlords then pay their mortgages to banks help finance, and you kind of get this circular aspect of the economy. We basically came in across the world and governments mandated businesses shut down and then go home. And so when that happens, you break the circle of life, right? And you get an upstream kind of stoppage. Think of it as a dam in a river. If the businesses aren't selling their products, all of a sudden the suppliers or the manufacturers don't have anybody to sell to. So they're now holding inventory. If they're holding inventory, they're not making more orders to suppliers. And so now suppliers are screwed, right? They can't pay their financing, et cetera. So kind of a dam occurs like in a river and you get this upstream impact. The downstream impact is if the business has no revenue, how does the business pay their landlords, right? So now you start talking about rent abatement, deferrals, forbearance, et cetera. And then if the landlord's not getting paid, how do they pay for their mortgage, right? And the problem is that chain reaction or that domino effect, both upstream and downstream, can have material impact because what ultimately occurs is at any point, if somebody is not given relief, and that relief can come in the form of the bank tells the landlord, hey, we'll defer, we'll give you forbearance, abatements, et cetera. You don't have to pay us on time or as much, et cetera. Or government assistance doesn't step in. All of a sudden, you get solvency issues. How is that landlord going to be solvent? They have no revenue coming in and they have bills to pay. Well, what are they going to do? They're going to seek bankruptcy protection, right? Same thing with a bank. If the bank doesn't actually have any sort of revenue coming in, but they need the capital, they may have solvency issues, right? And same thing with businesses. That's why you're seeing the government rush in and provide all of this assistance. And so I think what you get right now is you get a break in the economic circle of life. If that break is for 1 week or 2 weeks, people probably have cash reserves. They can kind of get by. I think a lot of people realize this is going to be multiple months type impact. And therefore, what you start to get to is if there is not assistance or relief, you will get solvency concerns. And so I think that's what people are really looking at, and we won't see that V-shaped recovery. Let's see. The U.S. has exorbitant privilege to print its own currency, courtesy of its global power. The world relies on the U.S. dollar to trade. Absolutely, the U.S. dollar is relied on to trade around the world. But again, don't forget that one of the big things here is the U.S. is not the only economy or central bank that's printing money. Everyone else in the world is also injecting liquidity or printing money into their economies and into the global financial system. And so one way to think about this is, let's say that the U.S. Increased their quantitative easing 2x, right? They started printing 2 times as much money, but everyone else did 2x as well. Well, actually, the impact on a country-by-country basis, everyone 2x at the same time. So you would keep the same kind of strength relative to other currencies. The problem becomes if the U.S. prints 3, 4, 5, 6 times as much as other economies or other currencies, then all of a sudden the dollar is getting devalued at a faster rate. And so you've got to really keep the relative argument in mind here. Brent Johnson at Santiago Capital's got a great theory. He calls it the dollar milkshake theory. I had him on the podcast. He did a great job articulating it. And essentially the dollar milkshake theory is that every central bank in the world is injecting liquidity into the global financial system. So whether you're the United States, you're China, you're India, you're an African country, South America, UK, wherever, right? Everyone is going to inject liquidity in. But there's only one currency or economy that gets to hold the straw, right? All the capital being injected is making a milkshake. But one economy gets the straw. They got to suck all the value out of the global financial system. And his theory is that the dollar, the US dollar, will be the one who holds the straw, right? And we're seeing that right now. All of that liquidity is flowing to the US dollar. You're seeing the dollar strengthen, asset prices sell off because everyone around the world wants dollars. What I foresee happening is those that don't have access to dollars for whatever reason, it's dangerous, it's not allowed by their country, etc., they will then seek gold or Bitcoin because that's the next best thing, right? The dollar is stable, the dollar is actually strengthening, the dollar has kind of the promise of the US government, and it's got a track record. But if you can't get dollars, then you're going to look for gold or Bitcoin. And so I think that's kind of what's happening with the dollar and the printing in the US, and then also how it relates to other countries. If in situations like this where the Fed is printing and it creates inflation, would stocks and all these assets go up anyways? Again, I think I covered that, so I'll skip over that. Let's see. You're not going to see any inflation while 20 million people don't have jobs. I think it's a great point, right? So again, that's why I say kind of there's like this 12-month window where I think it'll take some time before we actually switch from a deflationary environment to an inflationary environment. But definitely for right now, when you've got 20 plus million people unemployed, you got asset prices selling off and the dollar strengthening. I don't think that trend gets reversed until you, one, get people back to work, and two, you flood the market with dollars or other fiat currencies. And so that's when I think people will really start to realize how that happens. Can I explain how the Fed is bailing out hedge funds? Yeah, one way to think about kind of how the Fed is bailing out hedge funds in a very overgeneralized manner without getting into kind of all the exotic or nuanced aspects is think about what hedge funds do. They hold assets, but they have high leverage. There's many hedge funds that are 5, 7, 8, 10, even sometimes 20 times levered. And so what that ends up happening is when you've got a bunch of leverage and these markets get margin calls, right? Asset prices start to sell off, they get margin called and they're told, hey, give us more money, either post more collateral or you got to give us the asset. And so in those situations, what occurs is the Fed steps in, it provides liquidity to the market, and it's trying to provide relief. Think of kind of the bailout as it's relieving the pressure on those hedge funds that otherwise would have margin calls that they can't meet, et cetera. We've actually seen a couple of asset management firms or kind of market makers step up and kind of raise their hand and say, hey, we couldn't meet our margin calls, right? I think there was one in Chicago. I think there's been 2 or 3 others. So that's kind of how that happens. There's an argument to be made that that's important to do in order to preserve the integrity of the markets or kind of the sustainability of the markets on a global scale, because a lot of these hedge funds are holding certain assets that if all of a sudden they were had to sell in kind of a fire sale and sell everything, there would be a tailspin or kind of a downward death spiral of asset prices. I personally think that you've got to let the free market kind of operate here. And if a hedge fund got over leveraged and they can't meet their capital call or their margin calls, why should anyone bail them out? Right? They're professional investors. They understand the risk they take. Of course, yes, there will be short-term pain. Yes, people will get hurt, but that ultimately maybe those people shouldn't be managing capital. Maybe those people shouldn't be the ones who are actually doing this anymore. And so what happens is in those market corrections or downturns, you clean out the people who aren't good at their jobs, right? That's ultimately what's happening here. What do you think to save airlines by U.S. and neglecting unemployment? Again, people I think have come to realize I'm in the same camp as Mark Cuban, Chamath, et cetera. I think you let them fail, right? And that sounds really bad, but at the end of the day, what's happening is the airlines, Boeing, all these companies that are running to the U.S. government for bailouts, they believe that the government is the idiot in the room. And what I mean by that is what essentially has happened is let's again go back to let's use Boeing or United Airlines, et cetera. So United Airlines, I think, spent over 80% of their free cash flow for the last decade on stock buybacks. There's absolutely nothing wrong with stock buybacks, right? It's simply returning value to shareholders in a tax efficient manner. That's perfectly fine. But they've done that for a decade with 80% of their free cash flow. And the reason why they're doing that is because a lot of the executive compensation is tied to the stock price, right? The stock performance. And so if your compensation as a CEO, CFO, et cetera, is tied to the stock price, of course you want the stock price to go up. How can you get the stock price to go up? Well, you take free cash flow and you buy back your stocks so that you can prop up the stock price. And then you also put more debt on the company, use that capital that you raised in the debt markets to then buy back your stock, kind of a debt-fueled stock buyback, again, to prop up the price because you're getting more compensation for doing that. So the personal incentive is to do this, right? Now, again, perfectly fine. That's the incentives that the board of directors put into executive compensation. That is how the structure works. And that is actually what these companies did. Now, the problem comes that the number one rule of business is never run out of money. And so what has happened is they've taken all that free cash flow that normally would either sit on their balance sheet or they would have invested in R&D, and they've given it back to shareholders. But now we come into a situation where their revenue falls off a cliff, right? And so they need capital to survive. They need to continue to pay all of their expenses, their employees, et cetera. But they don't have enough capital on the balance sheet. So they've got to do one of three things, or really two things. They can go to the debt markets or the equity markets. But when they go and they check the debt and the equity markets, they go to investors and they say, hey, we need to raise capital to get capital on our balance sheet so we can continue to ride out this storm, to weather this storm. The equity markets and the debt market investors say, great, I would love to invest in your business, or I would love to lend to you. But the debt investors say, but I want a really high interest rate on this because it's super risky. I don't know if you're going to make it. And the executives look and they say, nah, that sounds too high. I don't like those terms. I'm not going to do that. So then they go to the equity investors and they say, hey, we want you to invest in our business. And equity investors say, great, I'd love to do that. I think your business is worth 1/10 of what you think it's worth. And of course, the executives say, no, I think our company's worth more. So they don't like the terms that they're getting in the debt or the equity markets. But remember how markets work. There's a buyer and a seller. And the way a market gets made is that the buyer and the sellers have to eventually agree on what the value of the asset is. The difference here is that the executives are pulling an ace of spades out of their back pocket, right? They're saying, wait a second, I actually have a third option. I don't have to go to traditional debt or equity markets. I'm going to go find the idiot in the room. Who's the dummy who will give me advantageous terms? Oh, the US government. So they then turn to the government and they say, you need to bail us out. It's imperative for the airline industry to survive. You can't let us fail. We are too big to fail. If you let us fail, look at how bad this will be. And so the reason why they do that is not because they can't find capital elsewhere. People in the debt markets and the equity markets would give them capital, but it's at unadvantageous terms or not attractive terms. So they go to the government and they say to the government, you've got to give it to us. And you saw like the Boeing CEO, he goes on television and he says, we'll take the bailout money, but they're not getting equity. Well, the reason why he's saying that is because every single other debt investor that he's talked to says, I'll lend you money, but it's going to be at a high interest rate and I want warrants. So I want equity in your business. But he doesn't want to do that. So he goes and finds what he believes to be the dummy in the room. And so if you look at like what Mark Cuban's saying, Mark Cuban's essentially saying, look, you have to get equity. You have to get just as good of a deal for the American taxpayer as the private investor would get. So whatever those market rates are on interest rate, evaluation of the business, et cetera, the U.S. government has to negotiate just as hard to get the same deal. It has to get a great deal, right? Why? United Airlines, other companies looking for bailouts, they are not what we call price makers. They are price takers. And what that means is when you're in charge, when you have all the leverage in a negotiation, right? In the good times, companies, there's lots of capital that wants to invest in good businesses. The good businesses get to name their price. They go to the investor and say, I want to raise X dollars at Y price. I'm a price maker. I make the price and the investor says yes or no. If they say no, there's another investor that will invest on those terms. I got to be a price maker. Now the roles have reversed. The companies are price takers. Now they don't have the leverage. The investors have the leverage, and the investors are going to take advantage of that. That's how capitalism works. That's how free markets work. And so investors are saying, I want to invest at a lower valuation. I want to invest with a higher rate of return. I want to invest with both lend you money and take equity in your business. Because now the company and the executives are price takers, they're saying, we don't like those terms. They're running to the government, and they're hoping that the government bails them out. Now, if you take it a step further, what Chamath believes, Chamath is actually saying, let them fail. Don't take their bullshit, right? Literally walk away from the negotiation table. If their starting point is you're not getting equity in my business for bailout money, literally tell them, screw you, kick rocks, and walk away. Why? Because if you can't get the terms you need, you have to do what every other investor would do. You have to walk away. And when you do that, the company will fail. Or they will go back to the traditional debt and equity markets and they'll actually take the money from private investors at the terms that they previously didn't like. If the company fails, though, right? Chamath made a great point on CNBC the other day. It's not like every employee gets fired. it goes through an orderly packaged bankruptcy. And what ends up happening on that back end of a lot of these bankruptcies is the employees actually end up owning more of the business than they previously did. And so it's like the airplanes disappear or all of their revenue goes away or all the employees get fired. In many cases, what happens is actually another team, right? Entrepreneurial team comes in, they buy the assets out of bankruptcy. And because it's a new team with new ideas, innovation, competition, etc., they actually end up doing better with the assets over time. And that competition drives a better industry and also drives a better experience for the customer. Right? If you don't think that other teams could take over the airline businesses today and do a better job than the current executives, you're crazy. Airlines suck. Everyone knows they suck, but they suck because there's not free market competition, because there's a lot of regulation, there's a lot of capital barriers, et cetera. And so allowing this to happen would actually improve the industry over a long period of time. It wouldn't get a lot of people fired. And what is likely to happen is that we wouldn't have to bail them out because they'll be forced back to go to the private market for debt and equity investors. So a little bit of a tirade there, but that's a really, really important thing to talk through. So I'm going to try to skip to some of the more recent questions here and see what I can get through. Do you think China is trying to buy up our equities? Great question. I don't necessarily have an opinion on that. What I do think kind of tangentially related to this is something to pay a lot of attention to is the oil market. So there's a lot of price manipulation obviously going on with Saudi Arabia, Russia, et cetera. And they've driven the price down so far that actually American shale oil producers are not able to operate at a break even or at a profit. So they're literally underwater while they're producing. What's happening is that depression of price, or that artificial depression of the price. I've read a number of articles now that China and other places are starting to buy up a lot of this oil. It's cheap. Right. So if you can store it, why not buy it up now at cheap prices? You can always sell it back into the market at a higher price or actually use it. And so you've just got a more efficient use of your capital. And so I think that's something where you can watch that happen. I'm not sure how that's playing out in equities. I haven't really looked at it, so I don't want to comment there. But we do see some of that stuff happening in the oil industry, in the oil market. So, it could happen, but I just haven't done enough work to actually have an opinion on that. So much background noise. Is dinner ready yet? Dinner is obviously not ready yet. Polina is cooking though, and she says she's struggling, but she's being kind enough to let me kind of hang out here with you guys while she's cooking some dinner. She says hello and to continue being kind to your friends. How would the government owning airlines help people? Yeah, so this is a really good question in the sense of, should the government get equity, right? And there's always the concern of is the government going to nationalize companies, industries, or markets? I think that what ends up happening is the government has to make a choice. You either don't bail out companies, or if you bail them out, you get just as good as terms as a private investor would get, right? And obviously, if the private investor and the government get the same terms, most executive teams are going to choose to go with the private investor rather than deal with the government. And so what I think ends up happening is you basically force people to not take government bailout money by financially incentivizing them not to do it. And so I think that's really how I look at how this goes. Joe Clokus, who helps me with all of the video stuff, is doing a great job. He just texted me and said, "LOL, Polina, hope you didn't break everything." So that's great. Stock buybacks are not necessary and were banned previously. This is a really important point. A lot of people don't know this, but up until 1982, stock buybacks were actually banned. They were illegal. They were considered stock manipulation. I think it was in 1982 they were kind of reversed and now legal. One of the big things, Meb Faber did a great job on the podcast with me explaining this, but essentially what a lot of stock buybacks basically are is they're returning value to shareholders. So there's two ways to return values back to shareholders, really three. So one is you can take some of cash and you can literally issue a dividend. You can take that cash, you can buy stocks, right? So it pushes up the stock price and all equity holders benefit from that appreciation in stock. Or you can ultimately sell the company and then just return kind of the proceeds of the sale. But those first two ones are important, right? Because they're returning value to shareholders without actually selling the business. And so the reason why stock buybacks have become so popular is because there was actually a law change where it's become more tax efficient to do stock buybacks rather than traditional dividends. And therefore the actual incentive is for the stock buyback rather than the dividend. Meb's idea, which I think is pretty smart, and he's definitely much more of an expert than I am, is that we should just change the tax laws so that a dividend is the equivalent on a tax basis to a stock buyback, right? If you even the playing field, all of a sudden people might not just buy the stock, they might actually issue the dividends, and that would kind of change the incentive on that standpoint. His other idea, which I think is actually a really good idea, is the whole idea of executive compensation being tied to stock buybacks is actually a board of directors and governance issue. So really what should happen is rather than there be any sort of government change, we should instead start to push board of directors to not tie executive compensation to stock price, at least in the short term. And therefore you remove the financial incentive for them to do things like stock buybacks, et cetera, right? One of the big arguments would be rather than continue to return value to shareholders through stock buybacks and dividends, if instead you made intelligent investments in R&D, that should actually lead to more creation of value for shareholders over long periods of time. Problem one with that argument is a lot of executive teams actually suck at R&D investments, and they end up just burning the cash. So they would have been better off returning the value to shareholders. And then two is because of the executive compensation being tied to short-term price movements of the stock, of course, they're incentivized to get the stock price up now rather than make the long-term investments in R&D to drive future stock price and value. So that's kind of how that plays out. Let's see here. Eventually the dollar drops. It will come, but right now dollars are in huge demand. I've got mine in the back pocket and holding in some trash bank either. Yeah. So look, for sure, at some point, the only way people have to understand, think of like when you're a kid on the playground and you know the seesaws, right? There's basically a seesaw between dollars and assets. And what I mean by that is when asset prices go down, dollar strengthens. Well, when the dollar weakens, asset prices go back up, right? And so you get this kind of opposite effect on those two assets. And so right now, dollar is strengthening and asset prices are dropping. But the only way for asset prices to recover is the dollar will have to weaken. And I think that's what, Crypto Elf is talking about here. Great name. Let's see. Stock buybacks. All right, I'm going to hang out for another 10 minutes. So get your questions in. Pomp, I work at a hedge fund in New York City, and we bring in speakers to talk to our traders. It would be sweet to have you come in. We film and release. Yeah. Kurt, go ahead. Just email me or DM me on Twitter. I'm happy to talk about doing it. He can find my email. I'm not going to give my email out to the 950 people on YouTube who are just going to send me crazy stuff. Is Kevin O'Leary secretly bullish on Bitcoin outside of the camera? Look, here's what people have to understand, right? Anything that you're watching on television, this is like a super, super important detail. Here's the big secret. If you're watching television, it's not news, it's entertainment. I don't care what happens, it's entertainment. And it's done specifically to inform the general public, always with an agenda. Sometimes that agenda is good. Sometimes that agenda is bad. But remember what you are watching. It's more marketing than it is news in many cases. And I'll give you two examples. So the first is Larry Kudlow. Many of you may know who this is, but Larry Kudlow is like the director of the National Economic something, right? He's supposed to be a big deal and be an expert. Larry Kudlow went on television right after the first 8 to 10% drop. And he literally was telling people on national television, everything's okay. Stocks are going to be fine. Buy the dip, right? BTFD, buy the fucking dip. Well, what ended up happening is the stock market fell off a cliff after he said that. He came back on television a couple of days later. I think it was Jake Tapper maybe, really pushed him and said, wait, are you telling people to buy the dip? And he goes, I didn't say buy the dip. I said buy the dip if you're a long-term investor. Nuance, but pretty big difference there. And it's because, again, it's all about a confidence game. As long as everyone has confidence, everything goes up in price. Everyone's kind of enjoying the good times, right? But the second that there's a loss of confidence, the market switches over and you get the momentum now pulling against the market and everyone's shedding assets and they're looking for dollars. And so what ends up happening is every time you watch television, remember, it's entertainment. It's not necessarily news. And you've got to ask, what's the agenda of the person talking? Why are they telling me what they're telling me? What's their angle? And that's for everyone, me included, right? Everybody that is sharing information, you've got to remember that. So when it comes to Kevin O'Leary, look, I actually believe that Kevin O'Leary understands Bitcoin really well, right? Everyone's seen the video from 2013. I do believe that he truly believes what he's saying, which he doesn't believe in Bitcoin, which is fine, right? It wouldn't surprise me if he's got a little bit, right? He claims to have like $100. I bet he's got a little bit more than that. But I don't think that he's necessarily misleading people where he's saying, hey, Bitcoin sucks and I don't get it. This is stupid. I forbid you from owning a lot of it. like he said to me on CNBC, but then he's got, a couple $1 million worth of Bitcoin and he's secretly trying to depress the price so he can buy more. I don't think that's what's happening. I actually believe that he does not think that it has value, which is fine. But again, obviously I think that he's wrong on that. So I don't think that people are kind of being malicious, but always ask the question as to kind of what people are doing and why they're telling you what they're telling you. Let's see here. What are my thoughts on the real estate market? I live in Las Vegas. I'm supposed to close a new house in 2 months. Should I back out and lose my earnest money of $4,000 or should I move forward? From Gavin. So I'm not going to comment on like what you specifically should do, but I will talk a little bit about the real estate market. And here's kind of the way to look at this. So many real estate prices. So forget like publicly traded ETFs and all that. I'm talking about the private real estate market. So either buying a home or buying commercial real estate. Remember that there is a lack of reaction or a slow reaction to these types of situations. So again, we're only 3 to 5 weeks, depending on how you count, into a financial crisis. It's not like you're going to go talk to people who are selling their homes before this crash. So people who put up their home or building for sale in January or February, let's say that they wanted to sell it for $100,000. If you go to them now and say, hey, world's changed, your building's actually worth $70,000 or your home's worth $70,000. They're going to tell you, shut up, you're wrong. My building's or house is worth $100,000, right? It's because there hasn't been enough time for them to realize that the market has shifted, that prices are coming down, et cetera. And so what I think is we're likely to start to see that now, kind of, 6 weeks in, 8 weeks in, you'll start seeing some people who are a little bit more forward thinking and kind of pay attention more to the macro environment. They'll start to realize that the market has changed, but I don't think you'll actually see a real impact for 3 to 6 months. And part of that is one, just the realization, hey, the world's changed. We're not in great times. We're now in this recessionary period. And therefore my building's just not what it was worth because the market has changed and the buyers are not willing to pay what they were. The second thing is the economics of their building are likely to change. So I own commercial real estate and I have a tenant who's supposed to be paying me and they're calling me up and saying, I can't pay you. Well, all of a sudden, the value of my building is dropping because I have a tenant that doesn't pay. So I have no income with the property. And so that's going to take some time to play out. And the longer we go into the crisis, the longer that will, or the worse that'll get for people. So I think that, real estate will be very attractive over time. I personally will start looking for real estate, both residential and commercial. I'm just not doing it yet. I'm kind of, very cautiously saying, okay, where will I look? But again, probably 3 to 6 months from now, I think that we'll start to see more attractive prices. And that's really kind of when you'll see the true blood in the street. And when it comes to real estate, for me, the way that I think of real estate is one of two things. Either I want a really, really good deal in great times where I know that I've got a great tenant, and we'll kind of be off to the races for a long period of time and we're protected, and we can, pay off the property, et cetera. Or what I want is an absolute fire sale where I'm coming in and I'm providing liquidity to somebody who's in a liquidity crunch, and they basically have no other options, right? And I think those are kind of the no-brainer deals to do. I don't see any of those in the market today. I think they will come, but again, I think those are kind of 3 to 6 months away at a minimum. Do I think middle seats on airplanes will go away? I do not think that middle seats are going to go away, but I sure, one, wish that they would. And two, I think that if we allow these companies to fail and we get new executive teams or entrepreneurs in, I do think that we can get much better leadership in there, which would be super beneficial, I think, for everybody, right? Look, employees get treated better, right? Shareholders actually gain more value, and customers get a better experience. So it's kind of a win all the way around. All right, let's go. I'm going to do one more question here. Or I'll do 2 more questions. All right. So can you talk about your altcoin diversification and thoughts on high frequency trading, especially in Bitcoin derivative markets? So Josh, my altcoin diversification is non-existent. I own nothing but Bitcoin, right? And people always ask, why is that? Why am I so kind of strong on that? And let me kind of paint you a much broader picture. So first of all is all of my exposure to digital assets, blockchain technology, kind of this digital age, if you will, is not just in liquid cryptocurrencies. Remember, we've got an entire business around investing in illiquid investments, meaning that we're actually buying equity in for-profit private companies in a venture capital model. So many people know we're investors in Figure Technologies, BlockFi, et cetera. And so we have exposure to what I consider more infrastructure or structural things, right? Some of those businesses benefit from things other than Bitcoin, right? So we've got a number of businesses that are building on top of Ethereum. We've got businesses that trade in all sorts of altcoins, et cetera. But we're investing in the infrastructure. So then when I look at it for me personally is my exposure professionally is to a lot of that infrastructure stuff. But then what do I want to hold in the liquid market personally? And the way that I think about this is it's a Venn diagram, right? On one side of the Venn diagram or one of the circles, I have what is an attractive return profile, right? I think Bitcoin and a number of other things have an attractive return profile, right? So if Bitcoin goes up in value and we go into a big bull market in crypto, I think Bitcoin, Ether, a bunch of these assets will all go up in value, right? That because the market cap will expand and multiple assets will benefit. But I think that also on the other side of the Venn diagram is a circle where I say, what is the probability that the asset will go up in value, right? And so I stack rank them kind of 1, 2, 3, 4, 5. Bitcoin is head and shoulders above everything else. I've got the most confidence that Bitcoin is going to continue to appreciate in value out of everything in the cryptocurrency liquid market. And so when I overlay those two circles, Bitcoin is the most attractive thing to me because I believe it has a lot of upside, and I also believe it has a high probability of that upside. So kind of it has that asymmetric aspect, but also a high probability of playing out. And so for me, the risk I'm willing to take is I basically want what overlaps. Now, some people say, I don't care about how probable it is. I look at it more as a venture capital investment. And therefore, I actually just want what's the thing that's the likely to appreciate the most into the bull market? Well, it's actually probably not Bitcoin, right? And the way that these things work is look at like stocks, for example. The large cap stocks actually have less volatility than small cap stocks, right? So when you have a drawdown, what happens? All of the small cap assets all draw down more than the large cap assets. Well, in reverse, in the bull market, what happens? Large cap assets appreciate, but usually small cap assets appreciate even more. Same thing happens in crypto, right? So on a day where maybe let's say Bitcoin goes up 10 to 15%, Ether may go up 25%, right? Or some other asset may go up 25%. But again, I'm not looking for what's going to perform the best. I'm looking for what's going to deliver enough of an attractive return overlaid with what has the highest probability of actually playing out. And so for me, that's Bitcoin. Other people have other things that they're optimizing for. So I think that's really important to understand kind of why I don't diversify in the liquid market and kind of how I think about that. Okay, let's see. One more question, and then we're going to be done here. Let's see if we can find a good one.
I saw one about your first job out of college.
My first job out of college? I didn't see that one. Let's see. Let me see if I can find one more here. Okay. All right. Here's a great question. What skills should we come out with post this lockdown and into a new America? So I'm going to talk globally, right? This is really, really important. The world has changed, but it's changed in two different distinct ways. One is there is specific changes around the virus, in my opinion. So things like people may not want to shake hands as much. People might be a little bit shy about going to places with lots of other people. You may see face masks become more popular, right? All this like fashion face masks, etc. So there's what I'll call like virus-specific changes to the world that are going to play out, and the world will be different in those specific areas because of the virus. The other thing that's happening right now is there's an acceleration of trends that were already underway, but the virus is simply an accelerant. So what happens is, let's say, for example, remote work, right? There's a lot of people who had heard of remote work before. They said, oh, it's just working from home. That's not my thing. Every day I go to work. I have my commute to work. I enjoy going into the office. This is great. They'd never tried remote work. They knew what it was, but never tried it before. Now, all of a sudden, the government mandates remote work, right? Everyone go home, stay at home. And so now they've, for a couple of weeks, got to try remote work. I think that we will see on a market share basis, like remote work, non-remote work just got more market share, right? More people will now do remote work simply because there was an acceleration of the trend, just because people tried it, right? And they enjoy it. They think that it's easy, right? I saw today Sheil Monat, who runs a fintech fund, and is just generally a great person. He tweeted and said that he talked to the founder of a very large finance company, a fintech company, and they were saying that they've been working remote and it's going very well. And they're actually considering post-virus not going back and getting an office lease. And what they believe it could do is save them about $10 million a year by not having to pay rent or buy snacks and do all that kind of stuff. So again, there was plenty of companies that were becoming remote, but how long would it have taken that company to go remote? It probably never would have gone remote, but now they try it out with the virus, and so you get an acceleration of that trend. Another one is digital learning, right? I had this tweet, I think earlier in the week, where I basically said, look, the sham is up in colleges, right? There's a lot of colleges that now are being revealed to simply be asset management firms that have a school. And what I mean by that is, Stanford's got like a $30 billion endowment, and then they've got the school. Well, that endowment is supposed to be like for a rainy day, to invest in the school, to protect them, to do all these things. And they have a very tax advantageous status by being an endowment tied to a school. It's very similar to like a religion, et cetera, right? And kind of the way that they manage their money. But what all of a sudden, we had a rainy day. Kids aren't going to the school. What you see is not the endowment stepping in and saying, you know what, we're going to pay for the salary of all the cafeteria workers, the janitorial staff. We're going to make sure that all of our students have the capital they need. We're going to make sure that the professors and the staff are all paid. Instead, what happens is they start to do hiring freezes. They do no bonuses. Some schools are actually laying off or cutting ties with vendors, and that then cause layoffs, et cetera. And so I think that people are just realizing, wait a second, why do you have $30 billion or $10 billion or $1 billion if on the rainy day you don't use it? Right? That kind of doesn't make sense. And so I think that we'll kind of see that trend of online learning, because now students are realizing, wait a second, I'm sitting at home, I'm on Zoom, I just attended my class. Why do I have to go pay room and board? Why am I paying $50,000 a year and taking on all this debt to do this? So again, I think that's another trend that will come out of it. So long story short is the virus will be an accelerant for a lot of trends. The virus will cause some virus-specific changes in the world. But the specific question here is, what skills can you come out with? Right. And the way that I bucket this is two things. One is I'm a big fan of what Paul Graham calls learning to unlearn. He wrote this fantastic blog post. I highly suggest you guys go read it. Paul Graham is the founder of Y Combinator. But basically what he talks about is, in school, you are taught to learn the answers for the test, right? You're literally taught, if I go to class, I read the book, I listen to the notes, there's going to be a test. If I get the right answers on the test, I did a good job. But then when you go to the next class, you forget what you were supposed to learn in the last class, right? You're only learning so that you can pass the test. And the example he uses is like, I think he says like, French Revolution literature or something. If you wanted to learn about the French Revolution literature, what you would do is you would just go read the 5 best books on French Revolution literature. You would consume that content. You would know it because you read the best content, and then you would be able to move on because you learned that information. Instead, because we have a test-based education system, is you don't actually read the best books. What you do is you read the teacher's material, because that's what's going to be on the test. And so whether that's the best information or not, you're just simply being trained to pass the test. And what he sees founders who come to him at Y Combinator and they say, hey, I want to pass the test, right? What's the playbook so that I can raise money? What's the answer to the test so I can sell my company? And what he says is, you have to learn to unlearn that stuff. There is no exact test. You have to learn problem solving. You have to learn critical thinking skills. You can't just simply study for a test, because life doesn't have a specific test. There's not a quarterly test or an end of year test. And so I think that's like one big skill set. How you do that is really hard. I think one of the best ways to do that is just reading a lot of really, really diverse content, right? Go and find the great thinkers from history and some of the current thinkers today, and just consume content from them. Learn how they actually use mental models, learn how they do frameworks, because I think that you'll be able to unlearn what you've learned in school and learn this new way of thinking that can be very advantageous for you. So that's bucket one, is learn to unlearn. The second bucket, I think, is what I call the digital skill set. And the digital skill set really is one big bucket that includes everything that you need for a digital economy. So can you write online? You should be able to do that. Can you use social media to distribute information? You should be able to do that. Can you learn how to communicate with other people all around the world on all these different platforms? You should learn how to do that. Can you produce content like videos and music, audio, etc.? You should learn some of those skills. Can you actually be able to run a business online? So can you sell things online? Can you build products online? Can you do all of these things? That all goes into the digital skill set. And each one of those is actually really complex. So don't try to learn it all at once. Instead, just pick something. Say, hey, you know what? I want to learn how to better use social media. Go figure out who's doing it well, reach out to them and say, hey, I know nothing about this. I know something else though, right? A great way to kind of approach somebody like me or others is to say to them, look, I know nothing about how to use social media. I know nothing about how to create content. I know nothing about how to sell things online, but I went to school as a chemist, and I've been doing this thing that I think is really interesting. And I've got a whole bunch of information I could share with you that I've written up. And that information will get you up to speed and give you, chemistry 101. And if you read these 3 pages I wrote, you'll have about 25% of the knowledge I have. I spent 4 years learning it, but you can learn it in, 2 hours. I'm willing to trade you. I'll teach you a little bit about chemistry if you'll teach me how to sell things online or create content or write better or whatever. Now, all of a sudden, what you're doing is you're giving value while also asking for value, right? Those types of people tend to get better responses over a long period of time than people who just simply say, hey, I don't know anything about this. Will you teach me? And so I think developing that digital skill set is going to be really, really important. So if you think of it as kind of a stack, you've got to learn how to think the right way for the world. So learn how to unlearn what you learned in school and learn critical thinking skills and mental frameworks, and then actually learn how to be productive in a digital economy, right? How do you create value, products, services, et cetera, and do it at scale with the tools available on the internet? And so I think that all of this is kind of a lifelong learning journey. But if you can come out of this quarantine with 1 or 2 skills that you didn't have before you went in, I think that you can kind of look back and say, hey, quarantine was a positive development for me. I learned a lot, and I'm kind of in a better position. The second thing that I will say kind of along these lines is if you have lost your job, which there's 1,000 people watching this right now. There's definitely somebody on here who's lost their job. Do not be afraid to switch careers. You basically have been put in a position where you were down one career path. You now have been put back to kind of the restart button. You can continue down that same path, right? Let's say that you're a worker at a restaurant, or you work in the service industry, hospitality, travel, all these different industries. If you were going down that path, now you have the opportunity to say, wait, time out. I lost my job. Do I want to continue in this industry, or do I want to go down a different path, right? Use this as an opportunity rather than a setback. And if you do that the right way, what you can do is you can retrain your skills, right? You can go and you can get trained as a computer scientist. You can learn other skill sets. You can get trained in marketing, et cetera. There's a whole bunch of resources out there. I just interviewed Ruben Harris on the podcast. He runs a company called Career Karma. Basically, you go into an app, you tell them, here's my goal, here's my current background, here's my current skill set, and they'll point you to the right resource to help you get trained. So they'll tell you, hey, you want to learn computer engineering? Great. Here's the 3 schools that we think that you should go to that are kind of online boot camps, et cetera. Oh, you want to learn marketing? Go here, et cetera. So there's resources out there. I highly suggest you guys put those things to work. I'm going to go eat dinner. Paulina made chicken wings, which if anybody's been watching Lunch Money, you know that there is a surplus of chicken wings in the world right now because the cancellation of NCAA March Madness. And so if you want some chicken wings, there are tons of chicken wings out in the world that are at a reduced price right now, and they can be frozen. So go pick yourself up some chicken wings, and I think that you can get some nice food. Polina is an excellent cook. I'm a lucky man. So if you guys can, please, I've been told, like this video, subscribe to the channel, go ahead and hit the alarm thing so you get notifications, take the URL, tweet it out, do whatever you can so that more people can watch this stuff. I really appreciate you guys all tuning in for an hour. I did not expect to go that long, but I was just, enjoying talking about this stuff. And I will try to do these more often, and I will see you guys sometime next week, probably. So have a great night. Have a great weekend. Stay safe, stay alert, be kind to people, and we'll talk soon.